Hello everyone, this is Krishnaveni. Again, we are going to see about how investment functions with the support of Excel. Yes. Now, our situation is our company X is asking us to make some important financial decisions. Like company X is a manufacturing firm that is considering a new project that will require a significant investment. The project is expected to generate cash flow of rupees 50,000 per year for next 5 years. And the cost of the project is 2 lakh and the discount rate is 10%. Now we want to assess whether we can recommend our company X to make investment or not. So how we could calculate? Every year the project is earning 50,000 per year. So obviously it is for 5 years, totally 2 lakh 50,000. What a normal common man will do, 2 lakh is our investment, 2 lakh 50,000 is the return. So we can make investment. But here the one thing that we have to consider is discount rate. What is going to happen to the money value is the today's money value of 1 rupee will not be equal to the tomorrow's money value of 1. So obviously we have to consider whether 2,50,000 is opt is an feasible return to this particular investment after 5 years. Every end of the year we are getting. Here the thing is discount rate. This discount rate talks support that this is the rate where we can at least the percentage of the money value is decreasing at 10 percentage. Inflation, say for example, if we are keeping money of rupees 100 in uh, a bureau, obviously after 10 years we could not buy anything with the 100 rupees of today what we are buying. So this is what we call it as a discount rate, the cutoff rate, and otherwise we call it as a cutoff rate. This so obviously here we have to find out the cash flows for the 5 years, 50, 50, 50, 50, and we have to find the present value of those 50,000. Today's 2 lakh will not be equal to 2 lakh of 50 year. First end of the first year 50,000 will not be equal to end of the 50-year cash inflow of rupees 50,000. That's why we are getting to this formulae, present value to be calculated. This is the syntax to calculate the present value with the support of Excel. We need not remember all these things. In the Excel, we are having an finance function. For in the formula, we are having financial function. There we have PV, or else equal to PV. If we are putting, obviously it will ask the important factors that we have to give input to this particular calculation. Yes. So here the present value can be calculated where we have to give the cutoff rate, number of periods, and the payment generated by the cash flows, and is there any future value of the particular assets is there. Now we are going to make investment of 2 lakh. That is the present value of investment, but there is no scrap or anything after 5 years or 10 years. So there is no present value in this particular thing, and here our assumption is we are getting this 50,000 cash flow every year at the end of the first year and second year, third year respectively. So where we are going to do this calculation with the support of Excel. Yes, our problem is here our today's investment is 2 lakh. Cash inflow generated by this particular investment is 50,000 for 5 years, and the discount rate is 10%. As I told, we can use the PV formula where first we have to give the input of rate. This is our rate, and number of periods is for 5 years, and payment generated by this cash flow is 50,000, and there is no future value. And here this future value cash inflows we will get every year end. At the end of the year we are getting the cash flow. This is the formula which we have to collect it. Here we are getting minus because here we can give in terms of minus So we can get the data in terms of positive value. So the value which are going to generated 50 equal to 50,000 for 5 years. The value for 50,000 for 5 years equal to 5 years equal to 25 2,50,000. This is the actual value. Totally we will get total cash flow of this particular project is 50,000. 2,50,000. But when we are discounting the money value at 10 percentage, here the value of the money which we are converting future cash flows into the today's value, the value is only 1,89,539 rupees. So this is the formula where we have to use this. So we have to make decision. Actually, today we are making investment of 2 lakh, but we are getting only 1,89,500. So here the value, present value minus initial investment, we will get the net present value. Here we want to make a decision. If the value is positive, it means it is able to generate the future cash flows positively. Obviously we can accept or make investment the proposal. If it is a negative, we have to reject this particular investment. Obviously here this is the net present value of this particular investment. Particular scenario, we need not make investment because we are not going to get the worthy return from this particular proposal. So what we are going to do, we are going to reject our investment. What we are going to recommend to our company X is, we have to make reject. We should not recommend them to make investment on this particular project, because based on the present value, net present value calculation, it is clear that the investor should not make investment on this project because the NPV is negative. Hopefully you will understand that this present value calculation is very much useful to make financial information and financial decisions. So we will use this particular tool to make investment decisions. This helps us to make quick and accurate decisions, and we can calculate the present value, and we can make informed decisions very easily. It is super easy for the financial manager to use this application. Thank you.